Mukul, Tej and Manu for joining us, the first episode of The Viewpoint, joined by my co-founder and CEO, Ankur as well. We'll let him kind of say a few words as well.
No, excited to be here. We are launching a very new product at IPV, The Viewpoint. Excited to have you guys here.
Happy to be here.
Thanks, Manu. So, we at IPV, we are very kind of uniquely positioned with more than about 7,000 investors who invest with us regularly, with about 170 plus portfolio companies built over just a short span of about 4 years. And I think we're very focused on building the ecosystem, not just investing, building in the expertise to help the founders grow, businesses grow, and then also building relationships with the next level of funders as well. So that's what kind of we have done at IPV so far. So not just monetary capital, but also a lot of experience, support, and building out for the future. What we wanted to do today was to look at how things have changed in the last 10 years. What has changed? How have things evolved over the last 10 years? And then look at probably try to understand why have those things changed over the last 10 years in investing and in the startup world. So that's where we wanted to do the first Viewpoint episode on. So Ankur, if you want to add to it, happy to.
I think one of the critical questions is what is the Viewpoint? The way I look at it is that today shows like Shark Tank India have brought startup investing into every household, if not every household, then in many households. And what happens with this popularity is that there's a lot of questions, there's a peak of interest of what is startup investing. And in my observation, whenever there is so much interest, there is an equal dose of information and misinformation that starts floating around of what is startup investing. But personally, we think startup investing, and we all are the beneficiaries of it, has a very long and profitable run ahead of it. And therefore, it's an important asset class for people to view. And so the objective behind the Viewpoint is to bring the key stakeholders, the founders, the investors, the businesses, the consumers, basically to bring them on a single platform, which we are calling the Viewpoint, to help the experienced investors, the novices, the students who want to know more about startup investing. So with that endeavor, we are launching the Viewpoint.
Thank you. So again, since the first episode, very respected names. So thanks for being here. So let me just start with Mukul. Mukul has about 10 years of experience in venture investing, has witnessed a transformational period in Indian startup space, led investments and served on the boards of companies like Urban Clap, No Broker, Auto Ninja, Prop Tiger, Bobble App, and Traction. And we all know Traction's IPO has done so well. Mukul personally primarily invests in consumer internet, mobility, and marketplaces, and isn't averse to investing in companies at concept stage either. So what we understand about Pravega is that Pravega believes deeply in the transformative power of entrepreneurs and invests in financial and professional resources to help them build their vision as well.
Also joining us today is my dear friend and managing partner of IVCap Ventures, Tej Kapoor, which is one of, don't go by his young looks, but he does have 20 years plus experience in investment industry. Prior to joining to IVCap, he was the global partner at Fosun and head of Fosun RZ Capital and Southeast Asia, RZ Capital India and Southeast Asia. His investment portfolio includes some recognizable names like Delivery, which he exited via IPO, also Ixigo, Kisht, where he was able to deliver some good exits for his investors. He is respected by his founders and his peers alike, and is a regular speaker at industry events. And so great to have you, Tej. IVCap is one of the earliest Indian-based VC firm which was able to successfully tap into the IIT alumni network across the world. At IPV, we have built deep communities of different IITs as well. So something to learn from IVCap as well. So welcome, Tej.
Thank you. So I guess the final guest, Manu, thanks for being here. Let me welcome Manu Rikhye. He's an accomplished professional with 16 years of experience in financial services businesses. His expertise goes beyond financial services, though core business strategy, M&A, leadership are some of his core strengths. Manu was founding member of Midland Credit Management India Private Limited, a wholly owned subsidiary of US-based Encore Capital Group. He has also worked with established brands like global Vantage, and G Capital International Services. And G is something we share as our alma mater as well. Manu is a co-founder at Merak Ventures, where the focus is to invest largely in B2B, and they're keen to invest in electric vehicles, batteries, carbon, and digital solutions, along with climate finance. While Merak is sector agnostic, it will look at almost everything in B2B with a particular focus on climate tech, insurtech, and SaaS. Alumnus of IIM Calcutta and University of Delhi, he's an avid golfer in his free time. So welcome to the show, gentlemen.
Thank you.
Thank you.
Wonderful being here.
As I said earlier, we wanted to kind of go into what, why, how have things changed in the last 10 years. What I also believe is that, because things are changing so fast, everything is new, nothing they've seen ever in history, it becomes a challenge as well. Identifying the right sector, identifying the right business, roadmap to success, nothing is guaranteed. So let me, today start with you, Mukul, and I think the question is, while you have seen both early stage and kind of seed stage investing, what has been the change in your approach into investing in the last 10 years?
Sure, Vinay. So and I'm a little bit going more back in the history out of the context. I started my career in 2006 with Canon Partners, and I was checking my notes sometime last year. And at that time, all these US VCs were there. Sequoia was there, DFJ was there, NEA was there. You name these big top 10 VCs, they were all there. And all of us put together used to invest around $60 million, 60. Yeah. That number is today $30-40 billion. Even in 2010-11, that number was $1 billion and change. And billion was also with lot of struggle, lot of fight. You have to, billion mein there will be a big tiger round in Flipkart. Yeah, that's when we reached to billion. So 60 to billion, then probably 3-4 billion and 20 billion. So obviously change is bound to happen. Back then, it was not even considered as an asset class the way we know it today. In my interaction many times with investors, it was used to consider as some projects without revenue, without profit, without company. KKRs of the world will not even define it as a company building exercise. So that was the time, and today we know where we are. So obviously changes are bound to happen. Few things to specifically answer, Vinay, your question, few things which have changed which has impacted my working style, way of thinking, way of investing is that one, the volume of data has been phenomenally high. I even remember my deal flow tracking sheet back in 2006 was an Excel sheet with 60 rows. Isn't it? And that was it. Yeah. For the entire year, you will keep analyzing those 60 rows, and today you know that deal flow data, isn't it? So the volume of data, volume of information, the volume of entrepreneurs hitting us on a daily basis is humongous. So at a fund, at least we try to say, how do you fair noise and signal what you like, what you don't like. You can't do everything. So you have to focus, you have to define your niches, you have to define your own investment style and do it. You can't cater to the entire market. Even today, I may not even know what my own firm is seeing on a particular month. I may not have seen all the companies. I may not be in loop of all the companies. So that's a very big change. The way as investors, at least I have evolved. 60 rows and probably couple of 1,000 rows keep adding on a quarterly basis. That's a very big change. Second, I think the pace of technology change has been a lot. Historically, the way we have seen, like in India, if we see the addition of a smartphone 8, 9, 10, it was very linear in nature. It was growing at 25% CAGR, 30% CAGR. That was a very big, it used to, we can model it on Excel. These days, at times, we can't model it on Excel, the way the UPI has evolved, the way the geo transferred the mobile internet. In like 3 years, the game changed. So that pace of change and to identify that what can hit you and what may not hit you is like you need to think through that part. You might not even get time to react to that change. And third is largely because the sector is not so big, there are a lot more external factors. There is regulation, there's a government change. Lot more players are participating in it with all kind of interest and all kind of intentions. So which is at least we need to think through from a governance, ethics, company structures, all those. So those are like largely 3-4 things which are in my mind.
These are phenomenal. I mean, at least for me, it's eye-opening that you could manage it in 60, 70 rows. The deal pipeline. Today, we have a CRM. We do use Salesforce to manage, right?
And no, I still have that Excel, and I keep looking at it at times. Yes, only 60 rows.
No, we do 60, 70 deals a year. Yeah. We invest in about 60, 70 each, right? I mean, so the pace has changed. I think.
How many of those startups have survived?
I've not seen that yet. But I'm sure, Bharat Matrimony was in that Excel,
okay.
Which I can definitely remember. Car Trade was in that
okay.
Excel.
Nice.
Make My Trip was in that Excel. Clear Trip Yatra was in that Excel.
Excellent.
Shadi.com was in that Excel. So those are the companies.
Good Excel.
No, but I think tell us a little bit about the external factors you mentioned, right? I mean, the governance piece, and I think that's kind of, coming back to the fore as well. So how do you think about it today, and how was it thought about 10 years back? It'll be good learning for me personally as well.
So, and I think this is related to the business of managing money and business of investing money. And when it increased to a certain limits, all kind of participants start interacting with that ecosystem. So people initially, like 10 years back, it used to be a hardship journey. People used to identify that starting out is a very difficult exercise. So only people with very good intentions will used to come, because it was not even considered as an asset class, isn't it? So we have seen entrepreneurs like Sanjeev and Deep come out of that era. But today, because somewhere the absolute dollars have increased a lot, there are all kind of players coming into the ecosystem, and there as an investor you need to think through how do you react to. So these questions were not that pertinent at least 15 years back. 10 years back there were cases in bits and pieces. There are few cases around. But today the flow is so much. There are 10,000 companies getting funded on an yearly basis. Historically it used to be 30 companies. So then the governance, your ability to monitor, your ability to track, and the governance itself has evolved a lot. Historically, if there are 3 things to be done, now there are like 50 things to be done. So how do you track that data? So it's a question which all of us need to answer. At least we spend a lot of time on that, and we have been spending a lot of time since 7-8 years. It's not a new thing for us, but we have been very, very cognizant since 7-8 years.
Manu, my next question is for you. So as Vinay introduced you in your background is a lot in finance. So I have a question for you. What are the changes you have seen in the last few months in the founders' approach towards capital? Or I'll take a step forward and say, what changes have you seen in the last few months, and what changes you would like to see in the founders' approach towards capital?
So I think the founders we work with, one of the hallmarks of their character is that they're very frugal, right? And if you look through our portfolio from the first fund that we raised under the GrowX Ventures brand, our maiden fund, you'll find that each one of those businesses is highly capital efficient, right? So from our perspective, we're just seeing greater attention being paid by founders that we've invested in, or newer founders that we're coming across, right? I think more than the founder mindset, I think because of the change in VC mindset, the investor mindset, founders are becoming more aware that capital is scarce, capital is finite, and they have to be sharply focused on return on investing, spending, expensing every single dollar. I think that in itself is very refreshing to see. For traditionalists like me, right? Look, so my background, finance, I don't understand how you build a business where there is no clear business model, there's no clear cash flow, and profitability is a Hail Mary, right? So for me, that's very refreshing to see. I think this will only accentuate as time will go by, because the current situation will, I believe, further deepen over the next 12, 24 months, which will actually reset the founder behavior and investor behavior in terms of asking for questions, bringing focus into stuff like that.
Excellent. So, so Tej, same question for you, because you have built some consumer businesses, invested in consumer businesses. There, the financial discipline was not always there. So what changes have you seen? What changes you want to see?
Yeah, so I think I'll pick up just some anecdotes from what Mukul said, one story, because I was at Naspers, right? I came back from US, and Ankur was also in US, and at AOL we used to see like talking about many rows of deals in US. The market was super excited. So when I came to India in 2010, again I just felt there's no deal flow, and I would take Nasper card, nobody would know Naspers, which was very funny. Yeah, I was like, these are large guys, and they would say like, who is Naspers? As a matter of fact, IBIBO card used to be more recognized than Nasper, and they were in total like four companies, I remember, which were of significance in the internet industry, and then I think the era after that was when the real money flow actually started to happen was 2015, right? When the Chinese got into the Indian system. I feel obviously Tiger was there, and some of the other Western players were there. Everybody was increasing their AUMs, but I felt Chinese gave us that pace of like coming back to your question on burn and grow, right? I mean, obviously Paytm is a great example of learning of QR code, and I was fortunate to like switch from the Western learnings to the Eastern learnings with working with Fosun. But their philosophy was very, very straight, that it's okay to burn for growth, but don't burn for unit level. At unit level, you have to be profitable. But if you are burning to grow business, it's fine. So, and that was a very Chinese way of doing things. So a lot of companies that we invested in, and also we did that. Like if you look at delivery, right? Delivery used to burn money, but at the unit level it was always profitable. Or Let's Transport, other company we invested in. So that has been the success story of Fosun. And coming back to like obviously IVCap also started in 2011, right? And now we are $400 million, probably the largest venture fund, and all money is Indian money, which is very extremely amazing, right? And I think they're also the Vikram and Ashish, who are founders of IVCap. Their philosophy, our philosophy is very similar, that and that's why I resonated with them a lot, that in terms of like, don't go after high burn models, right? You can create a consumer business by being true to yourself and not to just burn your way away, right? So I think that remains. Founder mentality, obviously Ankur, is changing quite a bit. I think like Manu was saying, it's also, I would not just blame founders, I'll blame investors. Because sometimes we drive things of sitting on the boards, etc., and they sometimes follow suit. So I think now founders are becoming cognizant of the fact this is not the same old days where nothing can be checked. Obviously we have been through a lot of frauds, etc., in the companies. Compliance has become very important. We are taking a lot of time to do deals and make sure that the level of diligence is deeper. I think even the diligence partners have changed their style. So there's a whole, I would say, reflection on what happened in 2021, which we are seeing in 23. It might not be like this, a couple of years, who knows. But I think everybody has become very cautious and very careful about, both investors and founders. So I see a very good welcome change that we needed. Yeah, so I'll stop.
I personally think that 2021 was very much needed for Indian startup ecosystem. We needed that shot in the arm. We needed that infusion of capital. We needed to see that growth in unicorns, which has brought startup investing to the front and center of discussion of mind space. But then 2022 and I think 2023, what is happening currently is also needed. Some bad practices seeped in, and I think this is the time to weed them out so that we can build a more sustainable business practice.
Sure. I think I'll follow up with Tej only. You said you've worked with Naspers globally and then in India, and you've worked with various companies in various sectors as well, right? What do you see are things that have stayed on or are similar to what they were, let's say, 5-6 years back or 10 years back? And what do you think is no longer similar and has changed? So how would you kind of rack and stack that?
Yeah, so earlier the choices for founders was very limited to raise capital. There were like 7, 8, maybe 12 funds who were active, and Naspers used to be the biggest daddy in town, because we did 100 million check at Flipkart, which was the biggest deal of that of that year. That has absolutely changed. Today you have like platform like yours, you have a lot of micro funds which have come into play. So I think you'll have to be going back to Mukul's point, you have to be really now founders are looking for what's beyond capital, right? I can there are a lot of pools of capital available. Now is it a relationship with the partner in the firm? Is it where they can add more value in our businesses? I think that's going to become more critical at the fund level, right? Obviously there'll be top rankings of funds, etc., but it has to go beyond that. Founders are becoming more and more attracted to people who can add other value than just capital, right? And I guess just to complete on that story, Fosun, while I was there was obviously the China Connect, which was great for founders. So they wanted capital, not only Fosun capital, but also access. Similarly, IVCAP, we have a mentor trust in which there are various mentors who guide these founders. So that's very attractive to them. So I think every fund has to find what is their niche. And by the way, fund has become competitive business too, right? Yes. There'll be a lot of funds who will come with clear, like your fund is focusing on EV, etc. So it's becoming more competitive so founders, good founders, to chase good founders, you have to be like something extra just more than money, right?
So that's very fair and very relevant.
That is about the strategies. On the other side, Mukul, how has your investment strategy changed in the last few months? As we have seen the changes. You are a consumer internet focused. You've looked at sectors very closely. But has there been a change in the metrics that you used to focus? And are there some new metrics that have become far more important than, let's say, 5 years back?
Sure. So, Ankur, Pravega is from a venture fund perspective, Pravega is a young fund. We are in a fund 2 journey. So, from that perspective, it is still a young fund. So, one thing which we did some long time back is we started focusing a lot on few sectors and few markets rather than do everything, because as Tej said, the market has become fairly competitive. So, we have become very, very focused. From last few months perspective, for us, nothing has changed. We were focusing on the same metrics 2 years back. It's just that we were not getting any deals 2 years back. Today we are getting far more deals. So for us, not much has changed from how do we evaluate companies. It's just that the market has become more conducive to our investment style. So only that thing has changed. Our deal velocity is increased for us internally as a fund. But for us, from our evaluation perspective, pretty much nothing has changed.
So what is like the first thing you look for in a startup? Even before you speak to the founder, when you're looking at the deck, what are you looking at?
Yeah, I am still a very old style investor, so I have to talk to the founder before even thinking about it. So my first port of call is just to talk to the founder. One thing I have learned over time that venture is very contra to your age in venture. Because you started become more and more pessimistic कि यार ये तो चलता ही नहीं है, ये तो ऐसे ही होता है, and it's a biggest enemy. In my opinion, it's my biggest enemy, and for any venture capitalist. And I've seen a lot of deals we have missed in SAF because we said यार कि ये तो ऐसे ही होता है इंडिया में. And venture entrepreneurship has the habit of challenging each of those past trends. So over the years, I have started pushing myself to not put that lens and start my evaluation after talking to the founder. But it's a daily struggle. I can't say that I've learned it because every time. So I let my junior team also. I hear them when they push back a lot, and then I think a lot about it, and I try to remove that lens of कि ये तो ऐसे ही होता है.
Very interesting.
And maybe I'll come to Manu then. You do a lot of B2B as well. And a lot of clean tech. Are you seeing more founders picking up agri, clean tech kind of ventures? Help us understand how that is changing.
Interestingly, when we invest in B2B tech businesses, we find that often founders that are attacking these problems are people that have spent years and have experience, they intimately understand the problem. From our perspective, what is exciting us now is that top talent of India is now taking on really big challenges and tough problems, right? So from our first fund, we'd invested in a company called Pixel, which was started by two young boys in their college who, when they pitched to us, had a vision of achieving asteroid mining in 2050. Right? So very often you meet founders who have bold visions, but what they demonstrated was they had the ability to think through a lot of detail and had a clear plan for next 6 to 12 months in detailed Excel sheets, right? Which was very encouraging. What we are now seeing is people like Avais and Kshitij are more in number, right? And that number is growing very rapidly. Interestingly, India is a very ripe ecosystem to find problems that affect humanity. You know, absolutely. We talk about agriculture. I was just talking to someone yesterday who's India's second largest feed producer and supply, animal feed producer and supplier, and he was saying, look, the math for a dairy farmer just doesn't stack up, right? So our social traditions, heritage tells us that every household should have a cow, but whoever has one is unable to make any money off it, right? Just because the cost of raw materials is very high and the cost of milk is stagnant, right? Someone needs to address that problem, right? Till someone figures out how to either provide better feed so that milk production goes up, or provide lower cost of raw materials so that the farmer can make more money, right? Problems like those to wastage in agricultural supply chain, right? Very large problem. It's not like India doesn't produce enough food. Actually, India produces enough food to cater to the whole world, but India also has the most inefficient agricultural supply, right? And distribution. So how can you solve that? And there is business that we're now looking at that is just trying to solve the problem that you and I as consumers don't fully embrace. So, you know, as you and I go out to shop for fruits and vegetables, often we pick the very best looking fruit and vegetable, but nature is not perfect. So what happens to the rest of the produce? It gets thrown away. But, you know, 20-30% of produce getting lost is a huge wastage. So now there are founders that are looking to solve those problems. So from our perspective, we are very excited. And I think we are now seeing very high quality deal flow. I think in the last 5 years, I don't have the experience that Mukul and Tej have, but in the last 5 years, we've seen some tremendous opportunities in founders. But this year, it's just stepped up, right? And people that are really serious about setting up companies, solving hard problems, are now taking the plunge. And very attractive and exciting businesses will unfold 3 to 5 years from today. That are being germinated now.
Oh, that's awesome. I think we did a similar investment with OTP. Idea was to cut the supply chain wastage down from 30 to 5, and I think that's where we're seeing the magic kind of really happen.
Varun's a great founder, yeah.
So one of the things that people would be very excited to, or not excited about, interested to know. In Delhi, the summer is here. You know, the jackets have gone away. When is this funding winter going away? So Tej, let's start with you, but Mukul, and you know, we will love to have your opinion as well. None of us have a crystal ball, so we can't predict, but we all have students of macroeconomics. So what do you think may precipitate the change, and when do you really think we can start seeing some spring?
Yeah, so I think in my view, there is no funding winter per se, but like, you know, all the investors are looking for returns, right? And they are saying, ki boss, you know, build good businesses, you know, just not valuations. So, and I think IVCAP, we are still writing checks. Early stage, I mean, sure, I mean, these gentlemen can comment, but there is, you know, still people who are doing deals, right? By the way, worldwide, there is $570 billion raised by venture capitals and different funds. So they'll be under deployment pressure. I think our internal view is that, you know, late stage is where I think there will be a lot of pain, because you don't have the big daddies, you know, like now, and they are becoming conservative. They are almost have to revisit. They have, you know, like it's like known public figure. Tiger is down 40%. And the public market in US is so attractive that you know that you have to put money there. I mean, if at an individual level also. So you know, the private investments will slow down, and especially if you are not valued right, you have definitely funding winter. But early stage, I don't feel if you're building a good business, I think funds will still write checks. There will be more scrutiny, so you have to be, and also differentiated. I think that everybody is looking for some differentiated play rather than run-of-the-mill companies. So I feel when it will turn around, no one can tell. I don't think we can ever get into 2021 kind of a phase. That was, $7-8 trillion printed. I don't know. That only happens once in 20 years. Some black swan event, something has to happen. So I think we'll get to regular business hopefully by, I would say second, third quarter of next year. Yeah.
Wow, another 18 months.
Yeah.
That's
my feeling. I'm personally. Yeah.
Mukul, do you agree with that timeline, or I think it should be shorter?
No, so I'm glad Tej said that there's no funding winter. I also think there's no funding winter. And since you talked about macroeconomics, see, pre-COVID we were $17-18 billion every year of venture investment, and we are a $3 trillion economy. So if you see those ratios are fine. So there is honestly no funding winter. It's a time of some cleanup will happen. Non-competitive businesses will weed out. Premium businesses will get more value, will get more pricey. And that's how in every asset classes happen. Even in public markets, that's how it happens. So probably, I don't want to comment on it, 12 months, 18 months, but we'll be pretty much business as usual maybe next year, but it's fine.
Excellent. Manu?
So where is this term funding winter coming from? I think it's coming largely from North America, right? And I think if you look at the US, there is a funding winter. There is a pause in how both investors are thinking and their LPs are thinking in terms of investments. Things are going to get scary there because fundamentals are questionable, right? So we were talking about macroeconomic trends. You've got the lowest unemployment rates in last 50 years, but inflation's still high, GDP growth is still uncertain, will US hit a recession? So I think you'll see a lot of that noise also percolating to India, right? So there is going to be, the pendulum will swing in the other direction. If 2021 was the year of exuberance, 2023 from a media standpoint is going to be a year of scarcity and fear, right? Now, the situation on the ground in India is that there is a constraint that investors are putting in terms of which companies they want to invest in. Investor dollars may remain the same, but you'd see far fewer companies attracting that capital, which is actually a good thing, right? Because this will ensure that there are the good companies, the businesses with solid models have a greater chance of success. So whether it's early stage or late stage, dollars are being deployed. Actually, from our perspective, this is a great year to be investing. Yeah, this is a brilliant year to be investing, especially in India, because while 2021 we deployed so much money across so many companies, to me, the fundamentals around economy were still questionable, right? I was still uncertain. So in 2021, we as a fund only made 3 investments because we weren't sure where this was going to go, right? And also the prices were very high. Even if you took on the risk of supporting someone, you weren't sure if as a fund you'll make the return that you want. 2023 is a great year for us as an investor, right? There is, like I was saying earlier, great talent available, people looking to solve real large problems. Economy, the real world, is in a very sure footing, right? You walk around, you talk to people on the street, they're feeling much better about themselves, about the outlook for the year and actually next 5 years than they were in 2021. So why wouldn't you invest, right? So I think all of us feel the same way, and I think most investors feel the same way. We're just going to be more prudent in the businesses we invest in.
Absolutely. We actually did because we deal with a lot of retail investors, if you will. And so we actually did a masterclass on why now is a good time to invest, because that famous saying of Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. 2021 people were being greedy, so it was good you were being fearful. You're out like for example in 2021, 22, everything EV was getting funded, and we invested during that time period in I think 3 startups in that space, because the valuations and the business models were just not making sense, even though the long-term strategy was very clear. Now people are being fearful, so there will be some good startups. And just continuing from the discussion we were having earlier, I often believe that not only India is a growth country, India is a country of problems. So wherever there are problems, there will be solutions, and interesting solutions will find their own backers. Yeah. So
I just want to add one data point. So I think if you look at different markets, right? So all these new age investment or startups, everything put together is 200 billion roughly. Yeah. Which is 5% of our GDP, like 3.5, 3.2 trillion. Now you compare that to China. China is at 35 to 40% of their economy size, which is at roughly 18 trillion, right? So, and if you believe in India's story, and US is about 35% roughly, which is, you put Apple, Microsoft, bunch of, all the other, Facebook, Meta, so I don't think we are there yet. There's so much room to grow, and even if we become 15% of India growing at, like, let's say whatever, let's say even if we add another 2-3 trillion in next 10 years, that pace would be faster. So, and if we take 10% of that, you're looking at 1.5 trillion or something, right?
The example, that comes to my mind is, I read somewhere when Jeff Bezos wanted to start Amazon, his stepfather wrote a $300,000 check. This is like 80s. That's the amount of check we write today. So, I mean, so just to understand, that's the perspective. That's where we are. We are 30 years behind where US was, or 20 years behind where China was. And like Tej, you rightly said, a lot of fundraising was done. And in the last 1 year, I think there has been some shift the way Western funds look at India. So there has been some diversion or some extra allocation for India versus, let's say, countries like China or some other Southeast Asian countries. And that capital is raised. It's there with the funds ready to be deployed. So at some stage, the money has to be put to work.
No, I'll pick on what Tej said, right? I mean, China is 17 trillion. A large part of this comes from their exports as well, right? How do you think that can India produce services or products in new age which can be exported? We already see a lot of exports in software, TCS and Infosys, etc. Do you see more exports coming from India as well? And I'll start with you, Tej, in the next 5-10 years from the new age products, etc. or services?
So yeah, we're already seeing signs of that. I wouldn't say we're nowhere close, right, to what China exports, and I hope we can get. By the way, that news about lithium in J&K, that's phenomenal, right? So
all the EVs,
something like that. I think Elon Musk will be definitely flying soon to India. But so there are a bunch of startups that I have seen recently, which are focusing on this whole export China plus one. I think one thing with COVID which helped India is definitely all the large, manufacturers of US have started to look at not only India, I would say, but Vietnam, Bangladesh, entire Southeast Asia as an alternate channel to China. I don't think we are, because China is, they know manufacturing like nobody's business, right? And they have figured out the whole ecosystem around it. I think there will be a lot of effort we'll have to put in, and which I think Modi government is doing it. Also, if you see the road infrastructure is amazing, right? It's changing leaps and bounds. So, I feel that proportion should increase. It is increasing, but if you look at the data also, it's increasing, right? Now, with the new age guys, think about manufacturing instead of building software. I mean, that has to be seen because we have a lot of engineers, right? So we tend to build software rather than go into manufacturing. But I've seen few startups now actually, improving the efficiency of the manufacturing, which could be the first way to, start increasing the export. That's my view.
I mean, with iPhone 14 getting kind of manufactured in India, MG getting manufactured in India, so stuff like that is kind of moving. Yeah. Any view from you, Mukul, and then we'll come to Manu as well.
Yeah, Vinay, on that, the way we have simplified for ourselves, and because we as Pravega focus on enterprise SaaS and fintech, and we ask ourselves, why enterprise SaaS? Is it the right bank of the buck? Is it right for us to spend time on this? And if we strip down everything, India is today is around $150-160 billion export services market, growing at low single digit, 2-3%. For last 6-7 years, and in initial days it grew at 25-30% CAGR, isn't it? All of us know that. Today in enterprise SaaS products, India is a $4-5 billion export revenue market. 4-5 kuch hai. Isme Zoho is browser stack. All these companies are included. Some of it is part of venture, some of it is not part of venture, which is fine. It's a different thing altogether. If you read a lot of other statistics and take some growth of 25-27% CAGR because it's at a low base, easily India will add $15-30 billion of incremental revenue in next 10 years. It's not out of bounds because base is very small. Services have grew at 20-25% CAGR in earlier days. So export revenue on products can also grow. And if we add $15 billion in next 10 years by very conservative 6x, 7x of multiple, we will add around $75-80 billion of market cap. So for us, the answer came here, we just need a single digit market share of $70-80 billion market cap, and we'll be done.
I think I totally agree with you. Because the COVID times have taught us that any services are transportable, right? I mean, we saw a lot of IT folks working out of India for the globe. We saw a lot of doctors working out of this place. Now we are seeing a lot of lawyers and accountants, etc. now sitting here working for the world, right? Earlier, a doctor could not have sat here and worked there. Now 5G surgeries are happening by Indian doctors sitting here, etc. So I think what you're saying kind of totally makes sense to me.
And if we do it right, we have a demographic advantage. If today any company has to do 1,000 developers anywhere on the globe, India is the only place.
Yeah, IBM,
English speaking developer, India is the second largest population after US. So if you have to put 1,000 developers, can't help it, you have to come to India.
I'll go back energized and charged out of the room.
And if you look at all the large big tech are run by Indians, right? That's huge.
From Google to Microsoft.
So I think that's where India has massive advantage over China, because Chinese.
YouTube went to India.
Yeah. Exactly.
At some point, we don't even need to compare to China.
Yeah.
There's no need to compare to China.
No need.
No need to compare to. We had $75-100 billion market cap in one sector.
Yeah.
It's a good enough market cap.
In fact, I was at this event yesterday evening, at Georgetown event. So I was meeting some prospective students. And so they were like, so uncle, what is your advice? So I was like, the dean of business school was also here. And so I was like, she will kill me, but I don't think you should leave India. That's my advice. I'm like, this is the worst time to leave India. I mean, the next 10 years belong to us. I'm like, the amount of money you're going to spend on your MBA, invest in a startup. This will get you more returns and then run your own family office 10 years later.
And both intellectually, because you will be vested in learning that entrepreneur.
Because you'll be, I'm like, this is not a good time to leave the country. This is the time to stay. And, but I truly believe in that. I mean, at the cost, this is the time to dig your heels in and,
Just to add to you, when I visit tier 2 cities is when I get even more excited.
Yes, absolutely, totally.
So when I went to Kovalam and I went with no expectation, some Kerala startup event. And I said, jo bhi hoga, like resort is nice, to be honest with you. I said, chalo, resort mein look hai, right, that property, right? And I went and there were 150 entrepreneurs. And I would say if not, at least 20-30 were easily VC investable. I met a unicorn founder. He is between Kovalam and Miami. I was like, what's happening? SaaS business ka idhar. Yeah, so and then I went to Jaipur, again same story, right? Thai event, again 150 guys, very enthusiastic, selling whatever they're selling. Chandigarh, all these places, Kanpur I've heard now, there's a lot of stuff happening. So, I think that's what is super exciting rather than just tier 1 cities. This happening and also Shark Tank movement.
I think in some ways, we have to maximize our advantage on the cost, right? So we've in the past demonstrated that India has top talent available at a much lower cost, and huge services businesses from IT services to offshoring got built, right? We've always said we have the prowess to build the products. Larger tech companies are being led by Indians. I think the next wave should focus around that, which is, rather than just supplying the lowest end or exporting the lowest end of our capabilities, we should be exporting value add services, right? So for example, product companies from India, which have the advantage of building in India. I was just talking to someone else who runs a large VC fund focused on space tech as an example, and they were saying, look, is it easier to build a space tech company in India? And my answer was absolutely yes, right? If you want to access top talent from ISRO, many of the gentlemen that work for ISRO will give you their advice for free because they've reached, in Maslow's
intellectual level.
So they're not doing it for money. But if you wanted to tap into top expertise in NASA, it's still a top dollar you need to pay, $500,000. So here you could put a satellite in operations in 2-3 million, whereas in US it's tens of millions, right? So from there to product thinking, product mindset has to be exploited to capture more value. And going back to manufacturing, there is a lot of excitement around manufacturing, and as a country I hope we crack the code on it. because it's needed to kind of lift the poverty. People are below the poverty line out of it. But I think, despite this China +1 push, to Tej's point, we've only been able to capture 5-7% of it. Countries like Vietnam still capture a lot more of this business being shifted out of China than India has been able to. And I think we're making some strides. And like you mentioned, Apple 14 is a touted thing and a great example, because that should inspire us to do more. But and that will happen, but more as a nation. From our industry standpoint, at least what I feel is it'll be more product-led growth, tech-led growth, which will drive exports than manufacturing.
Thanks, Manu. I think I'll probably shift gears and ask a more opposite question as well. We were reading this, and I'll quote it, right? Peter Thiel's Founders Fund, it says that venture capital is broken. It has shifted from backing transformational technologies to becoming a funder of features, widgets, and irrelevances. That's what he's quoted. What are you guys' views here? And maybe we'll start with Manu and then go.
So that's been one of our struggles. So, we talked a little bit about what is changing in our investing approach. So when we started our first fund, we took very bold bets, right? Space tech, one semiconductor company called Lightspeed. We invested in one robotics company that's solving bin recognition and manipulation of objects problem. We invested in a genomics and life sciences company attacking cancer. All of these companies are doing just outstanding work, like building world-leading products. But unfortunately, there is lack of availability of late-stage capital, right? So now as we building the next fund, we want to be bold, and we are going to be bold. The one thing we'll try and more actively figure out when we make an investment is how will we help these companies source for late-stage capital. Fortunately, that's happened in abundance for space tech as a sector, and now it's beginning to happen in electric vehicles, right? We talked about electric vehicles. We started investing in electric vehicles in 2019. We ran a whole accelerator program. It was a big focus for us. It was very hard for our portfolio companies to find follow-on funding. Like 2021, early stage funding has happened, but large pools of capital is yet to come to this sector. So I think that's one thing that plays on our mind a lot, and we'll try and see and hope that all VCs go back to finding these large problems, relevant problems, and capital starts to move in that direction.
We invested in BlueSmart and we invested in Kazam. So yeah, we kind of see what you're saying. Absolutely.
Yeah, so I see, so we have to, at least what we think about it, there are high alpha deals, which are in these, the new emerging sort of sectors, right, which you can't ignore. So whether it's EV, space tech, and then, clean energy is huge, blockchain, etc. So because we have raised 2,000 crores, so actually we can do both. I also think there are fundamentally issue of roti kapda makan still remains, right? Yes. You can't ignore that. Those are more pressing problems. Maybe not for India, but maybe for Bharat, right? I mean, it depends on, how you slice it, right? So you can't ignore that. Like biryani by kilo is doing extremely well. It's the consumer story in India is going to be strong as GDP per capita improves, and we have seen it in China, other markets. Other day I was reading Surf has become a $1 billion brand.
Yeah.
1 billion.
Yes, I read that.
So I still believe in the consumer story. Just that you have how your model changes and how you do it efficiently. So there's definitely our focus will still remain part of the fund to feed those businesses, and then we'll have the approach of co-investing money with some of the people who are actually building like or investing or supporting in some of, like, for example, Manu's companies, etc. So that that is also getting a lift. And then obviously fintech, logistics 16% of GDP is gone logistics. So that always remains evergreen sectors. There will always be opportunities which will come out of there. So that's how we think about it. I think Peter Thiel has gone to the next level of Maslow. So they are thinking.
No, Maslow just ended for him. He's probably just.
He's on top of it. He's got his own model. But one of my hopes is that in next 3 years we have more capital invested in these problems, Bharat, inclusion, hard problems, than, for example, in businesses solving 10-minute delivery, right? Because I think we can do better, right? So sometimes when I look at that, that frustrates me. But I guess there are things I just don't understand.
No,
yet.
that totally ties into that feature, kind of stuff, right? Do you really need that?
But also the thing is that there is a different audience. So I belong to your school of thought. Who needs 10 minutes delivery? My 8-year-old does need 10 minutes delivery.
we fed them that, right?
So when he wants something, so he's like, Papa, just order it on Zepto. And I said, it's not on Zepto. There is Blinkit, there is Swiggy now. There's like, just order it.
Absolutely.
Like, so it's not, I don't know if it's even morally right to promote that, but I mean, the kids do, so there's an audience out there. Again, it's the beauty of India, right? It's India, Bharat, or whatever it is, right? There is an audience for every product, but then going back to what you guys said earlier, the unit economics need to be positive. So till you can't solve that problem, then this 10 minutes delivery will not make sense. Yeah.
Get anybody to pay for it.
Yeah, that's the point, right? That's the point.
Yeah, will somebody pay for a 10-minute delivery, the premium that comes with it?
Yeah, no, pretty much the same. I think the Thiel's context is very different on where we live. For us, a cheap EV rickshaw is also a transformative technology because it helps 10 million people to ferry from one point to another. So it's a very different context. Second, I personally think the venture has now become very big from an amount of dollars perspective. It has become an asset class. So it will get diversified. There are different kind of investors coming into the play. Then each investor have their own. Everybody is not behind transformative tech. Somebody may be behind NBFC, somebody may be behind businesses. So that's bound to happen. If the asset class has to grow, it'll bound to happen. It will not get limited to a certain section only. Now, just to quote a number, in AIFs in India is 30% of the mutual fund base.
Yes.
It's very big. That's why SEBI is sweating that we need to regulate it, because it's 30% of the mutual fund base. So it's a very big asset class. You just can't say, we just, everybody has their own,
And everybody will find their
own sweet spot, own criteria, own thesis, and they will invest. And then our context is very different from Peter Thiel's concept.
Our problems are different.
are more real. Are more real.
Yes.
We have to take Peter Thiel to a village in UP.
Yeah, let's try that, I guess. So I will come to, I think, last few questions, and maybe I'll ask one which is coming to my mind. As you look at cap tables to invest behind, and as more angel investing comes in, today, do you think that having more angels on a cap table is a concern for you guys? Not a concern? Especially when, if there are enough safeguards built in. For example, at IPV we have a general power of attorney from every investor, right? And we take those decisions as a VC, even though there are multiple cap table entries. So how do you guys think about it, and what's the thought process right now there? Maybe we'll start with Mukul and then.
Sure. So this thing has evolved over time. Historically, 7-8 years back, only very few angels who were like tech founders, technology people, they were only angel investors 10 years back. Yeah. Today, the color of angel investor has also changed. There are few positives, few negatives. Positive that founders' ability to raise capital has become better. There are different people with a diversified thought process, so founders are able to raise capital. I think the challenge where we have seen with too much fragmented cap tables, one, it has to put in the right structure, in the sense that a very small section of angel investors should not be able to hold certain decision making of the company. That's a very important part. That's a core. And second, at times we have seen, which I can say that it's none of my worries, that people do invest with a very wrong thought process. Founder have promised them something different, they have thought something different, something else has been communicated, something else has been invested, but that's a more of a maturity evolution phase. So as long as there are right structures put in together from a decision making perspective, it's fine. Yeah, because the number of angel investors have exponentially increased.
And I think that's good in my view, because a lot of experts, a lot of senior folks who are doing angel investing, they can bring a lot of value in.
Yeah, that's right.
And if you're controlling it through a GPOA, where centrally somebody
whatever
can
that
take a call,
structure is, it can be through SSA, SHA, it can be power of attorneys. As long as there is a right decision-making structure in place, it's fine.
Any views from you, Manu, Tej?
I'll add to that. I think what Mukul said, I agree. I think when I see on cap table like some entrepreneurs boast of it कि 100 लोगों ने पैसे लगाए हैं. I was like, that's in my view is bullshit. Sorry to say, मतलब that's good endorsement to you, but how are you managing these people? It's very hard. So I think it is better they come to a channel like you, and I feel that that angel also, they are going through their journey. They have not seen that money can be lost. What right does an angel investor has on the cap table? Like zero, right? So if they are coming through a platform there, they can be represented, I think is much better, rather than just putting some of the seasoned one, people who understand this, I think is fine. Like, even when I was, at first when we couldn't invest, I did 40 angel investors, but I understand the game. Yeah. But if, you have the person investing who starts losing his money, then he will, be saying, then he has a lot of dissonance, I think. So it needs to be structured is better, in my opinion. Even for VC, it's better to see like, 2-3 names rather than, 30 names on the cap table, right? So, yeah.
Yeah, so I think it's been said, consolidated with decision making being held by an entity is better, because then it's easier to deal with. But I think, like you said, it's an important development that's taking place in India. Tej was just talking about how there are founders in different parts of India, in tier 2, tier 3 cities. For them to reach out and present to some of the VCs is hard. They don't have access, they don't know who to reach out to, etc. For them to be able to raise capital, build businesses will make it easier. Also, I've come to realize VCs have frameworks basis which we invest, right? अगर आपके वो checkbox नहीं होते तो you don't look at the company. Often angels provide initial pool of capital to folks like those to get the idea off the ground, get enough momentum for everybody to start to take notice of that business, right? And which is great for the founder, which is great for those investors, it's great for the whole ecosystem. So I think it's a very positive development. I think we've also gone through the learning curve of that and how best to manage it, and platforms like you and others that are doing it effectively help founder and investors like us deal with those challenges and issues later.
I have a question for you guys actually. So because you have been doing it for 5 years, how have you seen like the angels grow on the platform, the excitement level now, given there have been, but they are not disappointed with all the whatever frauds, etc.
So we have seen a phenomenal growth. I mean, we started with 40-50. Today 7,000 plus are active. Wow. Right? And we deploy about 300-350 crore kind of year. We'll deploy it this year. And we have had 180 cap table seats also, right? We have had phenomenal returns for these investors because very early stage, right? Think about it. BharatPay, we invested at $3 million valuation. Blue Smart, we invested $5 million. Fable at 3-4-5 million. Torch at 3 million. Today they're all above $100-200 million valuations. So average IRR has been north of 50% for us. Wow. Average IRR with only 6 failures out of 170, right? So we've been able to prove to them that if you do a portfolio of 20, you will be safe and you will have 25-35% IRR guaranteed kind of stuff, right? That's what the quality of work that has happened, and that is what's happening is without a sales team in place, we don't have a single salesperson. The word of mouth travels very, very fast, and that's where we are seeing a swelling happening. So when we launched our Category 1 AIF, April 21, it is today the largest Category 1 AIF by number of subscribers, and today 70% of our money flows in through Cat 1 AIF, right? So we are seeing an explosion here, to be honest, and that's where my question came. How do we really change that kind of framework or thought process that, and this is all regulated by GPOA. Every person who comes on the platform gives us a perennial GPA for all investments they do through IPV, right? So we have the right to kind of overwrite their thought process any point in time. And the proof of the pudding lies in, we have done deals with Reliance last year with Milk Basket, we sold off, not a single issue from IPV. We did Fable with TPG, not a single issue. We did Torch with US investors, not a single issue. All of them went very smooth. So that tells us that this kind of a way can work, and this can create wealth for a class or a section of society that was never available to them. So democratization really of this asset class, which was not even an asset class in Mukul's view, 10 years back, is happening. And to testimony, what he said, 30% of mutual fund base today is AIFs. We believe it can be as big as mutual funds. So if I don't know if that answers your question.
And are you seeing that there is better awareness amongst the angels? Has that learning curve?
Significant. They tell us your valuation looks high. They will call us, and we have a social platform on our app. They will post stuff, and it's publicly posted, right? We do master classes every Saturday, right? Sessions like these are gonna go to them, right? They are far more learned, and as you said, right, Shark Tank has added on top. Today, my intern comes in and says, when I joined as an intern, I was not sure, or my family was not sure we were going to work. Today, my younger brother asks me, what is EBITDA, what is gross margin? So I have, a very good position in my family, coming from a tier 2, tier 3 town. So, absolutely, it's changing phenomenally last 2-3 years.
What's the this 7,000? How much is tier 1 and tier 3?
So out of the 7,000, I would say we have NRIs as well. So maybe about 15 to 20% would be an NRI base. Coming through category 1 AF, so it becomes a local money. Tier 2, tier 3, you will see towns like Ahmedabad, Calcutta, I don't know which way you want to put it. Ahmedabad, Pune, Hyderabad, Chennai, all of these places.
Baroda, Surat, Aurangabad. You will see investors from Raipur. So you will see investors spread out. Of course, domination comes from Delhi, Mumbai.
So by quantity, it will be about 20%. Yeah. By value, it will be lower. Well. But we have not spent a single rupee going there. Yeah. I'm going to Chennai, Hyderabad next week. First time, right?
So we are no more scared with fragmented cap tables. Obviously, if there is a GPA, then it's the best scenario. But if there is not, then we tend to deal it with SSA, SHA. In the sense, we put threshold limits that, let's say, if 30%, 40%, 50% people approve, then decision goes through. That's how it is. We put those disclaimers. It also works for angel investors because a lot of times they get screwed by no rights. So it helps both ways. So you have to be fair. They should get information rights. They should get fair economic rights at par with future investors.
And we do disservice we may do disservice to ourselves by moving them out with even information rights, because some of them could be the sharpest finance brains who may look at the financials and say, no, these numbers are not adding up. Now, your analyst may not be able to figure it out by even going into the Excel, but there would be a sharp investor, who has built the business, and then they're looking at this financial and they're like, okay, these numbers are not adding up, please go and look at them. And that happens to us.
They keep us honest and transparent.
Our investors, we have a quarterly call after the investment. They will come, they will look at the numbers, and our founders will be like, okay, no, we don't understand that how did your revenue increase by this, but your cost, there is something wrong here. They'll just look at the number and they'll tell you. And so to your point also, Manu, you asked, it's both. So some investors have come through the learning curve. Yeah. So they have become far more informed and they have spent time educating themselves. Right? Many of them tell us that this is a MBA for them because they learn, by coming to this. But at the same time, there is a new class of investors which are very new. And they get carried away by a lot of misinformation that gets spitted around, right? And they will come with a notion that, oh, is it a fraud? Or
that evolution journey will be there.
Pardon?
That journey will be there.
Yes.
Journey will be
and
there.
the beauty is that the people who have learned earlier 1 year back are the ones who teach these guys. Yes. We don't.
We don't have to reply. Those investors are saying no. Like even today there was a question that somebody asked, oh, will I get a investment opportunity? And then there was a person like, yeah, I've been able to invest in 90% of these startups I like. Those kind of things, or how do I evaluate, or how do I think? So I think when you create a community and you let that community grow, and that's what we are seeing in IPV, where experienced investors who have learned through it, people who had no idea what startup investing is, they've spent time, they now respond to the investors coming in. So everybody is satisfying their own self-actualization needs actually there.
No, 350 crore of deployment a year is a very substantial number, yeah.
Also, by the way, I have seen in my circles at least, it is also once they make investment, it is a discussion point, right?
Yeah. Social.
Like it's the new visiting card you carry.
It's the bragging right you carry, right?
Bragging right. It's like, yeah, वो VC होगा मेरा पैसा भी लगा है. I think that's an interesting thing.
I'm also a shark, basically.
Yeah,
That's what they're telling me.
That's how I explain my mom what I do. I play this every day.
Maybe I'll then ask the last question, my favorite one. Do you guys have any anti-portfolios? And if you want to explain some of those, and we'll start with you, Tej, and then go to Mukul and Manu.
Oh my God, I have tons of them.
That means you're a very good investor. That's the only way you can be a good investor, right?
So we had opportunity to invest in Swiggy. It was a little bit later from Fosun at like 3. I mean, I love the founder, but my colleagues are not sure about whether the market will translate into making money. And obviously, it's a high burn model. Yes. So, but I still think it's a massive miss from our side, given where Swiggy is today. The other big one is Rapido. So Rapido, I saw at 10 million. I saw at 25 million. I just couldn't build the conviction. And going back to Mukul's point about, how would women sit behind a pillion ride? I just couldn't get over that, bias.
Today they do. All of my office staff does like that, right?
So I was like, so that was a huge, I think, a huge miss for us. I think, and then we had Big Basket also. Then a bunch of them which come to mind. But I think these two stand out.
Yeah, I have many because we've been investing since long.
आपकी तो 60 की Excel file है आपकी तो.
The biggest ones are, I think, Flipkart and Freshdesk. Flipkart came to us multiple times, but always couldn't able to get through it. And then Freshdesk came at Series A. He was asking 12 million. We were stuck at 8 million. Didn't happen. So those are like very big anti-portfolio.
Yeah, so mine are open banking, which is a very fascinating business, and the other is BharatPe. So we saw BharatPe when he was raising 2.5 crores. Till 2 years ago, everybody said it was a big miss. I think the jury is now out. I think the third would be Kenco, which is an insurance play. It's great business. I think they've got great traction. We just couldn't get conviction.
Oh yeah, best friends kind of stuff. College, yeah.
Good guys, yeah.
Good guys, yeah. Cool. Anything else?
Oh, thank you. It was great.
Awesome.
Hope we'll do more investments together and.
I look forward to it. I think there are a few we will continue to evaluate. Anything you guys want to ask us? Open, transparent.
You have any? I mean, I have a question. Like, how do you pick, your companies? Like, because you get a lot of deal flow. I'm assuming through VCs, directly founders reaching out. Some of our companies have also reached out. So how do you guys select?
So we are very open about it. Our criteria is out in the public. We look at about 5,000 to 6,000 deals a year. We are sector agnostic, so we see everything. So 3 main ways of thinking is in 3 buckets basically. One is it a great business? Is it a great team? And is it reasonably valued? In the great business, we have about 10 parameters split into 100. Will somebody pay for it? Is it solving a problem? Is it a big problem? Is it unit economics positive? Will it grow? Can it scale? Blah, blah, blah. Under founder bucket, I think that's a tougher one, and that's what we have cracked. The vision, the ability to articulate, the ability to communicate, ability to work hard, having the right technical capability, ability to network, ability to handle various, stakeholders like employees, vendors, customers, investors, or a board, disgruntled customers, and the like. Ability to get the right people on board, ability to hold people together, ability to hire. So that I think is our core, where we are able to look at the founders very sharply, very early on, because those guys don't change much over the next 10 years, right? Whether it was BharatPe we did, and whether it was BlueSmart we did, whether it's OTP we did all at like $2-3 million valuations each, right? So I think that's where our core becomes, and therefore the kind of culture we drive and the kind of discipline we drive is there. Reasonable valuations also we look at. So we are fine if we lose something at a very significant valuation, because to your point, right, will as a fund will make money. When my angel investors make money, right? So that's the broad piece. But we have 100 checklists in bucket 1, 100 checklists in bucket 2, and about a 30 checklist in bucket 3 that we diligently go through and keep dropping deals through the process. And it's a large team. It's almost a 180 people team that we run.
Oh wow.
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 I was going to ask you, like 5,000 companies, how do you evaluate them? Like 180 full-time?
Full-time employees, yes.
Wow. I didn't know
God,
that. That's huge.
insane,
Yes, 170 portfolio companies. And we don't stop at investing, right? We have a large network of CXOs and experts who help every company get from one stage to another. OTP being a great example. We brought in 6 experts on various areas after we invested to take them through Series A and then to Series B and beyond. So with that, we come to the end of the first episode of The Viewpoint. Really big thanks to Mukul, Tej and Manu. Thanks for being here. It was great having you on. I look forward to staying connected.
Thank you.